Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, I like to actually show this on a profit and loss graph as opposed to write it out. It's much clearer to me to see it. So notice I wrote the word midpoint here. When you're entering butterflies, especially on a lot of the exchanges, the point that you want to focus at a lot is where's the midpoint of it. To me, that is like the theoretical price of the butterfly based off of what the marketplace is implying. So if I could ever get a midpoint fill, I'm doing very well. So a lot of times will try to work my butterflies, and I notice that I usually get better fills a little bit later in the day as the markets are coming closer to a close, because market makers like to trade with them because they're a very delta neutral trade, and they're able to use butterflies to hedge their portfolios fairly effectively to take the other sides of the trade. So a lot of times be patient with them. They don't move a lot. They have a fairly low delta overall. So they're not going to move a lot, especially if we start out with a 35-day butterfly. But that also is kind of sad because if you look at this profit and loss graph at expiration, wow, this is a wonderful trade here. It really shows you I can only lose $1 and I can make $4 on the upside. But unfortunately, that doesn't usually happen until much, much closer to expiration. So if I go in and I'm looking at my trade here, and I pull up my butterfly, and let's say we're a really good butterfly trader. In other words, we're going to be 100% right, which you can always do in a theoretical options class, right? So with CDD at 125, I want to show you how butterflies move as they move through time, and this addresses the way that I like to trade butterflies. But if I look at them, and it started out at 125 with, let's say, 40-some, or right about 35 days remaining to expiration. The butterfly is going to be trading right around $1. When the market moves and we're 100% right, guess what it's trading for? $1.19. So in other words, it went up 19 cents. Another 7 days go by. Now it's $1.30. Woohoo! I've been exactly right for 14 of the 35 days, and I'm only up, it's gone from 103 to 130. Now as we move along, we're now up 145. We're still, remember, right at the 125 strike. We're dead on. At 114, we're up quite a bit more. But if I look at this trade, now we're doing something on a percentage basis. And this is one of the reasons why, when I'm talking about butterflies, we did this entire trade for $1.03. It's now trading for 68 cents. That means we'd be up $65 on our one butterfly, or 65 cents on the total price. So if we look on that on a percentage basis, we're now up 66%. And I kind of like the concept of trading butterflies, trading them a little bigger, and if I'm going to trade them as not as a hedge, but as a way to try to make money, I don't want to try to mess with that last week to expiration, because there's a lot of upside potential, but there's also a lot of risk. So I prefer that if it's within 14 days to expiration and it's at that short strike, a lot of times I want to try to get out of that position. Now, one thing that would make this more profitable is if volatility went down. If it went down, that is a good thing for butterflies. Why is that? Well, we've sold 2 at-the-money option contracts. Where's the stock at? Not right now. It's at the money. That usually means that they're expensive to buy back. But if implied volatility decreases, they will be cheaper to buy back. You kind of get my theme. Now, here's what really usually attracts people is that they get down in this range and they've made a pretty decent gain on a butterfly, but they look at this and say, gee, if it just stays there for one more week, I'm going to make this amount of money. All right. Now, that also means that if it just goes outside of your range, too, you're going to make absolutely nothing. So there's a lot of risk in the last couple of weeks to expiration. And if you want it, a lot of people say, well, gee, I'll buy them here and try to sell them there. You can do that. But then this becomes a much, much riskier trade in these 2 weeks as opposed to these weeks. I would prefer to trade them here if I have a bearish view on volatility, and hopefully if volatility just stays the same, I get a decent rate of return, and if it comes down, this would actually increase the profitability of the trade. All right. So here's another butterfly, and I got a few more that I want to get through, but I wanted to show you one thing before we did this. 1 second, I got to pull up my. I wanted to show you how this kind of works. If we look at a butterfly in general, and we start here, this is our TradeKing profit and loss calculator. This will actually show you, here's what the net delta of the position is when it starts. This is a 1 by 2 by 1 butterfly on Canada, or on the Canadian versus US dollar. And if I look at this, right here, we did this entire trade for about $1.16. I did it right at the money. I tried to make this very accurate as to when this was put on the other day. This is what this butterfly would be trading for today. So if we put on this directional butterfly, all right, oh, I'm sorry. I had that trade up. I'll show it to you here. This butterfly, the market moved down. This is what the butterfly would be trading for today. Real market quote, 116. Now, here's how it moves as you move through time. If we cut the days in half, there's 31 days now. Let's cut it to 15. All right. Notice, not a big jump in profitability. We go from flat even up to 36 cents, assuming we bought it at $1.16. Cut it in half again. Now we're up 79 cents. Okay, in the last 8 days, now we really see a big increase, and now delta is becoming larger. And then as expiration approaches, even larger. Now we got a much larger delta. And at expiration, boom, now we've hit the home run where we made the $300 on the entire butterfly. All right, so this definitely shows you how that butterfly moves as it moves through time. All right, so now let's cut it in half, and let's say we're right about our direction, right? So far we have been compared to Thursday, just got lucky, if you would. But let's move volatility down. Volatility in these things are trading around 23, 24%. If we move it down a little bit and say volatility goes to 20%, which it would be a decent move in volatility, but can happen in this day and age. All right, so let's move it down 4 points. Oh, it's 26%. All right, so we're going to move it down 5, about 5. And I just do that with the little slider. We're going to do it on an absolute basis. Now notice that went from being up $33 to being up $75. So let's go back to 0. All right. Back down to down 5%, 62.85. So you can see that volatility right here, it says for every $1 movement, this position picks up $6 of volatility. That's what Vega is. This is a position Vega. It's totaling all these numbers right here. All right. So interesting way to go on out. If you were going to just buy, because this option contract is fairly expensive, if you were going to just buy the 118 put, you have to pay a lot for it. With the butterfly, we can pay a lot less. If volatility does come off, we can actually increase our vol quite a bit across the board. And it's just a much cheaper way to take a directional play on this trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.